All right. Well, very good. This is actually this is being recorded, of course, and that's why we don't have that many members right here because they know it's going to be recorded. This is a very important seminar today. And the reason being is this I'm going to be discussing the conflict between the T20 and the T20-1, which of course we will discuss, but the T20 and the T21 versus the 89 bounce, because this occurs all the time. The question is, I have a potential T20 sell, but right in front of me, I have an 89 bounce to buy. Which do I do? And that's exactly what I'm going to taking a look at here. Now, of course, it's we have to talk about our understanding the risk. Trading has a high level of risk, and trading is not suitable for all persons. And past returns are not indicative of future results. Additionally, from time to time, you're going to see some hypothetical disclaimers. And the reason being is I'll actually be doing in the future a tremendous amount of webinars talking about the algorithms and the statistics for many of our strategies in regards to indicators and other things. And in order to do that, you have to do a tremendous amount of back testing. Well, everybody has to do that in regards to creating research. Well, the only way you can do that kind of number of trials to have enough research, you have to go back test a long time in the past. So that is a hypothetical. And so we have to do it because that's how actually we create our discoveries. Now, what I'm showing you here, I'm going to show some chart techniques that I use as a instructor. I'm going to show you that we have some dots. This dot, this black dot, is when the 8 exponential moving averages is underneath the 34. I'm going to show you these little two dots when we have an 89 bounce. Now you may ask, are these indicators that are I can get in regards to our members? I'm afraid not. And the reason being, these are really proprietary teaching tools that we use for IamADayTrader.com. And if you have Thinkorswim or Ninja or TradeStation, or you have other platforms, uh, talk with your available experts that they can also create some similar chart techniques. But what is unique about IamADayTrader.com is that I'm able to create some technical tools to make it easier to spot our potential trades. So again, that dot right there is when there is a close underneath the 8 exponential. The T20 is a potential entry in regards to selling. Now the T20 is what is known as a crossover approach. When the 8 crosses under the 34, it's looking for shorts. If the 8 is above the 34, it's looking for buys. That's a general crossover approach. And therefore, if you are watching a flat market, you're going to see these dots go back and forth. That's basically a potential sell, potential buy, potential sell, potential buy, potential sell, potential buy. This is when crossover approaches do not work. So watch the 34 on how flat it is. And if someone is having trouble with sound, you can go up to the top right on your webinar and reload the uh, webinar. Okay. All right. So that's the first thing you've got to understand is when you are in a flat market, you cannot buy and sell the T20 as if it is a system. So everyone, let's click yes or that you understand. I want to make sure everyone understands that if you are in a flat market and you see that 34 just go wiggle back and forth, back and forth, back and forth, you cannot take every trade in the T20. Actually, that's actually very true in regards to all crossover systems. A trading system is when you take every trade every time when it is accurate in regards to the crossover. You actually crossover approach actually wins less than 40% of the time. There are times in very poor market conditions that percentage will be at 30. So as you can tell, it is very low. That is if you take every single trade like it's a system. And that is one thing that we never suggest at iamadaytrader.com. Actually, all of our strategies, we do not suggest a trader take every system, every signal like it's a system because you're not going to have the best performance in trading. Now, the question I'm talking about now is the problem, and I say problem. Here is the 89 moving average. That is the 8, that's the 34, the 89, the 200. This little dash line here is a 535. Yes, Jeff, I'll like I say, on the regards to testing the 21s, I'll have some similar, or in the future, I'll do some webinars that is normally based upon uh, basically, basically, um, the only reason I'm slowing down here is because it depends on how you exit the trade. So, and which we'll discuss that by the end of the day here. So when I say test 20-1, well, it depends on how you're going to exit the trade. Do you want to have a profit target? Do you want to have a trailing stop? Do you want to hold the trade until the 8 exponential crossover goes in the other direction? Okay, so it depends on your basically your style of trading. So here's the issue that I'm looking now. Here is the 8. It's underneath the 34. But what is the trend right now? The 89 is very strong. It's moving up. It's very bullish. So is the 200. So in regards to should I take the T20, even a potential T20, because you had these two bars that moved up, then it's beginning to move back down. So you could actually say that that is a T20-1. You would normally want to see a little more of a bounce, which I'll have some other examples here. But that is a possible. But the thing is this, RT25, which we'll focus on another day. Now you're looking at a 34B, I mean, an 89B. What do I take? I have a short here, and within 5, 6, 7 cents, I now have a 89B. I have a close, and that's what that little dot is. That dot is a reminder of me as an instructor. We have a close underneath the or actually we have the low underneath the 89. This little plus here is that we have a close above the 8 exponential. That is our trigger for the 89B. Which do I take? At the moment, based upon a little more of research, the 89B is generally the better trade. But I'm going to show you some discussions about when it should be avoided. And it's based upon where is the price versus the longer time frames, which we'll discuss that obviously by the end of the day. So when you, again, you're seeing a possible, this dot means it is now above 34, the 8 above 34. It's coming back. It's starting to move back up. We've got a close, and you may have a, quote, T21 on the buy side. But look at the 34 on how flat it is. The 89 is still in a bullish bias. Obviously, the 200 is in a good bullish bias. So let's move forward a little bit. We now have still, that dot says we now have a close underneath. That is the, which is obviously true, but the 8 exponential moving average is underneath the 34. We're now getting underneath the 89, but it is still sloping higher. So we still have the potential of an 89B, a bounce. And sure enough, just a little bit longer, here comes the T20 again as a long. So in general, the better trades for T20s and the T21s are in the direction when the 89 is in a strong bullish trend and the 200 supports the bullish trend as well. The better trades are, again, on the T20s when you are having a very good solid trend. And primarily, of course, as trend followers, that's exactly what we're looking to do. Now we're beginning to see the dot. That means we now have a close underneath the 8, and we obviously, the 8 is underneath the 34. So we're turning into a bearish crossover, crossing down actually in this particular case. But notice the difference between where that occurred versus the previous T20s. It's now becoming to be more bearish. So let's move forward. Now granted, today was a very flat day going back and forth. But this is a detail, I mean, it's just being detailed, but this is the kind of trade that we're looking for in regards to the T20s. T20-1, because now this is our first little bounce here. So you can look in this area right here in regard to T20-1. What's going on when we have that T20? Obviously the 34 is going down, but what else is now finally occurring? The 89 is now moving down. So the T20-1s and the T20s begin to have better results when it's moving in the direction of the sloping 89, especially if the T1 occurs underneath the 89. Because actually you can see here we had a little bounce. It did hit 34, but look at the direction. Look what's happening here. It's starting to move down. Another thing I want to discuss about this is the profit targets. There are times, uh, I know I get some grief about this from time to time. There are times that you can have a larger profit objective. Yeah, yes, that's true. This is very good, Jeff. Jeff is noticing that this is only starting to move back down a little bit. So very good, Jeff. Excellent uh, point here. This is why I prefer the T20-1s. The T20-1, by the time we have their first, a little bit of a correction after the T20 under is basically the 8 is now under the 34. By that time, it's now bouncing up, and you can see now the 89 is solidly now going down. Yes, at this particular, let's talk about taking a look at the stochastics and the MACD at that particular time. The T20 and T20-1, which is the crossover moving average approach, is not too concerned with the stochastics. It is not too concerned about the MACD. Granted, most of the time, if you have a price start to move down early in the trend, you're going to see the MACD generally get below zero, depending on the setting that you use at your platform. So as a general rule, if prices start to move down early in the new trend, the 89 is going to be moving down, the 34 is going to be moving down, but in this same area right here, the MACD is going to be below zero. You can almost count on it. Now, am I going to then watch the divergences thereafter? No. The crossover moving average approach is, well, this little dots right here, I'm about to show you what these are. So we're moving back here, and what I'm saying is every one of these dots right here shows you where the crossover occurred. Every one of these previously were what? Above the 89. This one was when it is now underneath the 89. So the T20 now is underneath in regards to the 89. The T20-1 is underneath the 89. By that time, stochastics are actually the longer period stochastic is probably going to be moving down. On regards to a 5-period stochastic, which I'm going to do a future seminar, basically a webinar to discuss stochastics. Stochastic is not going to assist you at all in regard to these trades right in here. Because when we talk about a 5-period stochastic, it's very easy to bounce up all the time. These little 2 dots right here, or little dashes here, that is discussing and hitting when price hits the 200. The question is now, we've talked about the potential conflict of going short when I have a potential 89B. And at the particular time, depending on where it is in the longer term trend, which I'm going to discuss, the bounce of the 89 is a very good valid trade there. Now we're talking about I've gone short. Here's my T20. I've already gone through 89. What about now the 200? Should I buy because of the bounce of the 200? On that, I'm going to show you here, try to help in regards to, do I just ignore the 200? Art, exactly right. Look at the chart. But let's talk about this. Where the trade occurs in regards to T20 and the T20-1 depends on where price is in the longer term trend and chart. Here it comes. It's been moving up and it's been going up for an hour or two. Here it goes. It goes up 3 hours. It's now right there. It's already moved maybe 70, 80 cents, maybe a dollar from the lows. So what do you think? Do you think the market's probably due a setback? Yeah, I think so. So here we come. Price comes down, and here comes the 34B. Oops, stopped out. It's now hitting the 89. It's coming up because we had an 89B right here. But then when you look at the moving averages, let's say look at a 200, and it looks like this. It's sloping up, but look at the huge differential between the 200 and the highs. This is the one where when you look at the T20s, and I have a potential, sorry about, I'm pretty bad on the, even when when I was young, I was not a very good artist, period. I couldn't even do it in the lines. I just couldn't do it. All right. So we've got a 89B. Okay. Well, here's the problem. Do I now take the 89B versus the T20 sell? Because remember when I discussed before, the 89Bs look, pretty solid there. The question is, how high is the current price basis the little bit of history here? If we've had a solid trend of from the lows from 60, 70, 80, 90 cents, and that you're looking at a huge difference between the current price and the 200. This 89B, you might go, I'm not so sure about that one. What about the T20 though? I'm going to hold and go ahead and go short because I have a T20 sell. A little bit of a correction, I've got a T20-1. Now, what do you think? If I am at very high levels and the current price is way above the 200, do you think I should take 5 ticks of profit? What do you think? Give me give me some ideas here. No. Most of the time, you're going to take some nice profits. But there are certain times that you go, wait a minute. Well, I think this thing's going to have a bigger fall. So if that's the case, this is the type of trade that I'm talking about in regards to have a larger profit objective. Because it isn't because we are talking about a market in which it's having T20s and the slope of the 200 it's going up, but it's not particularly strong. The current price is not that far away from the 200. On the anchor chart, it's hardly going up in the 89, then yeah, take 5 to 10 cents of profit target from time to time using the T20 or T21. But if prices are way up, then there's nothing wrong with saying, I think I'll see if the market is going to do what? Break the swing low, which I'm going to show that in just a second, underneath the 89. Because I can actually get an additional 5 or 10 cents. I could make $100 to $150 in that same trade if I just watch the market and be more careful of how high the prices are when I'm getting triggered. All right. There's sorry for the all right, there we go. Now, this is a good example right here. Prices have actually gone earlier, had gone up in a little bit of a run. And we now have a potential T21 and prices are beginning to fall below. This was a potential profit anywhere between 15 or I'd say 20 cents, but that's probably not real because you probably take some profit in this area and you're looking at 15 cents. That is 3 times more than taking a 5-cent scalp. All right. And as you can tell, that one day, that one trade pays for what? Maybe 1 or 2 losses. That's why I'm talking about in regards to there are times that you need to have a larger profit in a trade because it pays for the flat market, which we've had. Like I say, it's been something else. That's all I can tell you in regards to the prices over the last few weeks. All right, I'm going to show you the example here. Prices are now coming back. We now have prices hitting the 200. Prices are now hitting the 89. And this black dot's kind of underneath there. We're looking for a potential 89 bounce sell because the 89 is going down. Not very much though. So we have a little bit of confusion because that T20 right here and the little setback is a possible T1 on a buy. There you go. There we go. We're going to talk about the consolidation here. You now have a consolidation. You have obviously the 200, the 34, 89 is now all together. However, the 535 is the equivalent of the 200 in regards to the anchor chart, the 610. It is still sloping higher. Just as a little more information about a potential trade. What I'm showing you right here is we have the 89 bounce and now we have a potential T20 sell. When and if that is violating these highs, take a look at your higher time periods. I know many of you have multiple monitors. Take a look at either the 15 or the 30-minute chart. If they are extremely strong, From time to time, many of our members have talked about Renko charts. Renko charts, its primarily reason is looking for breaks of support and resistance. You don't have to use a Renko. You can actually just look at the chart and say, okay, I have a breakout of the previous resistance. Well, that is what we just saw in this area of the chart right here. It hit the 89. It's trying to go short. But at that same time, what did we see? Well, the 34 is awfully flat. The 200 is awfully flat. And the only thing that we saw is that right in this area was within 5 cents. One of the strategies that you can follow, and I'll obviously talk about this more often, I want you to take a look at the last several weeks here. Take a look what happens when I take an 89 bounce, buy or sell, and price basically breaks above the resistance or support in that trade in regards to the 89. You'll be surprised that from time to time, it not only stops and you have a loss on the 89B, but it breaks through like you saw. Now, granted, in this particular case, it also occurred very close to the 9 o'clock period. That was actually a very fast run. It would have been actually very difficult to actually execute. Your slippage would be pretty high. So all I'm saying is that on a normal day, you may be surprised that is going to run in your favor. In this particular case, it required to looking at the higher time periods, which I'll be talking about that later. So here we have again a T20, two bars setting back, possible T20-1, right at the 89. And as you can tell, it took off. Again, if you were taking the T20 and you were looking for the higher time periods where you say, this is getting more and more bullish here, I'm going to take the T20 and hold it. That, again, is your big winner. Only because what? By the time you took into that trade, you are what? You are now above the 89. Let me see if everyone understands exactly what I'm talking about. The reason we're taking a look at the T20-1 then is because what is our entry in the T20-1? A close above the 8. Was it above or below the 89? Well, it was actually above the 89. That's what I'm talking about. We have a T20 now above the 89. That wasn't the perfect condition here, which I'll talk about in just a little bit, but in this particular case, oh yeah, well, saying that, remember, anytime that you see the close above the 34, obviously by that time, your 34 is almost, well, it's not almost always, it's always going to be not sloping down, and as general, it's going to be sloping better. Yeah, exactly. We just had, like I say, we had a tremendous amount of resistance right that same level, and it just went through. But actually, what occurred there was, guys, was the pit session. The pit session uh, turned into nothing but buyers. Are exactly right. In fact, I was going to be talking about the same thing. We now have all the moving averages moving up. And obviously this is the potential quote T25. You're only looking at a 2-bar setback. Maybe some traders will call that an ABC correction. But in this particular case, that was a potential trade. I don't mention stochastic too much, but on that particular trade, you obviously had a lower fast stochastic for a potential setup as well. But what I'm talking about for today, we're talking about the T20, T21s. There is a difference between taking every T21. All right, well, let's watch this right here. Prices have run pretty good. Here is our 89B. The moving average is still underneath the 34. Here comes the 89. But actually, we didn't eventually have a close above 8 until here. And as you can tell right now, the 89 now is getting extremely flat. And this is, again, when we have problems in regards to trying to make a decision here. Again, I'm going to just show here. We're going to go back more in history here because this was not the best days in regard to show all of this. But in this case, we have on the black dot, we see that we have a 8 above the 34. Prices are right at the 89. If you were starting to look for a potential T21, we now have the 8 back under, back above, back below, back above, back below. This is why we cannot trade every cross. Now let's take a look at what's going on now, kind of a bar by bar. We now have a close underneath the 34. However, the 89 is pretty flat, isn't it? We're now watching the correction here as a potential T21. It has not crossed over yet. Yeah, exactly. But let's say there's at this particular time, the moving average are still sideways. But watch the 89. It is slowly, slowly starting to move down. Where did the swing in the 89 stop? Right here. Watch the prices when it does what? There. This is the 535, or the equivalent of the 200 exponential moving average in the anchor chart of 610. The bounce off of the 200 is almost a coin flip from time to time. Previously, yeah, exactly. It's kind of like a pivot, but the problem is one day the 200 holds in a 610, one day it doesn't. This is why I say that if you are looking for the T20 and the T21, if you're in that trade and it's starting to work it for you and you're looking for a larger profit objective, there are times that you may I don't say ignore, but don't be too concerned quite yet that the prices have stopped at the 200 in the anchor chart, especially of the other higher time periods are becoming more and more bearish. And this is actually what happened in this particular case. Very flat market. You could have taken, because you still have the 8 exponential is underneath the 34. It didn't quite hit a 34B. It was within 1 cent, and many of our members will go ahead and take that 34B. Meaning, if it's close and I like the trade, I'll go ahead and take the 34 or the 89B from time to time. So many of our traders would have taken the 34B sell. Obviously, your stochastic is well above, very high, while the slope of, I'm not concerned about the slope of the longer term stochastics. It's quote oversold, which is a potential trade waiting for prices to move down. So if you were concerned about taking that trade there on the T20s because of the flatness of the 89, of the 34, even the 200, once they're now all aligned, you are more bold in taking the short. The 535 is, a lot of times it'll be temporary in regards, and you're seeing exactly what it is. That is now saying that I use the 535, actually most people obviously are looking at the 200 exponential for their timing. Again, look at your profit objectives here. Even on these trades, there are times not to take a 5 pip profit. You're looking at a potential of 15, 20 cents. Just two of those in a day makes your day. So again, when you've had really flat markets, from time to time, you are going to see when prices run, and you need to catch those from time to time. Here is our cross above 89. Well, we're touching all of this right here. We now have the 89 here. We have a 8 above the 34, and it's running right into the 89 and the 200. Again, where did that occur? That dot is letting me know I am getting that potential setup right at 89. I'd like it to be above it. And sure enough, here comes the prices are having a little bit of a problem because we have a tremendous amount of resistance. Again, the 89 is now getting flat. I'm going to get off of this day, and I'm just going back in time here. Here is the 89B. It's starting to try to move down. We have a T20 buy. We have two down candles. And we have now a potential T20-1. And we are now breaking what? The highs of the potential bounce at the 89. And so when it violated this high, that's what I'm talking about in regards to the break of resistance when prices are moving above the 89 on the previous swing, especially if it's what? If the trend is bullish overall. Now at this particular time, we don't have it. The 89 is still sloping down. The 200 is sloping down. But that's a legitimate T20 and prefer, again, if prices move above these highs of the potential sell in regards to 89. Once prices have run a long ways, you're now seeing finally a correction occur. But look where these T20s occur? Are they above or below the 89? They're above. Again, when I see a bullish trend, 89, 200, and I have a potential T20 right in front of 89 bounce, I'll take the T20. I'll take the 89 bounce. If the T20 is underneath the moving average, then I will be more focused on potentially taking the T20 and actually looking for a larger profit objective. Does everyone, do you see on this particular chart example what we're talking about here? This is a good example of the conflict between the T20 and the 89B. That was a potential 89 bounce, and there's the T20 trying to sell. But the difference is it's right in front of 89 instead of underneath the 89. All right, any other questions? We got about 15 minutes. If you have any questions, does it take some time? Yeah, it does. It definitely occurs in consolidation. But remember, if you're taking the 89B, then um, you're going to have to give it some more time. It definitely didn't even come close to hitting your sell stop underneath this swing low. But in this particular case, the T20, before it got basically set up here, it already moved back above the 8 above 34, back below, back up. This now has more of a trade in regards to the now again, this is the T20 buying bullish. We have the T20, the 8's going above 34. Here's our correction within that trend, and the 8 is still above the 34, and we now have a T20-1 in the direction of the strong 89. Well, uh, yeah, exactly right here. The 8 is above 34, which is actually what, as far as what we're looking for, is a T20-1. Any other questions? And then I'll take a look at a quick time chart that may also help. This is one of my favorite approaches, is the T20 and actually my favorite is T20-1. I wait, normally I'd like to watch for the first correction after having the T20. But I prefer that those trades are in the direction of the trending 89. Unless what I'm about to show you regards into the price time. All right, let's take a look at charts. I have a 30-minute chart, just to show it. You can use a 15-minute, which I'm going to show you in just a little bit. What I'm talking about right in here is take a look at the trend in the 30-minute. It was kind of, now saying that, we've had a little bit of, we've had some unusual type of pricing behavior. Uh, Recently, we've had these little runs relatively fast and out of nowhere, and then we sit for 2 hours, then we run And then we set, yeah, it's almost like OPEC, you're right. Uh, we have 20, we have 20, 30 cent sideways price movement, sometimes 15 cents or less. Today was a good example. We did basically you prices ran quick and it sat for more than 3 hours. And then it suddenly false breakdown, false breakout, and we get this mess. It is what it is. But if prices run, the reason I'm showing you, this is a standard 50, or let me see it. Let me see if I put the 34 on here. That's a 50. This is a 50 period simple moving average because it's very popular among many, many charters. Saying that in commodities, you can, some people have the 40, they have the 34. Um, what I'm showing you is look at the separation between the moving average and the highs. And when you see a large separation between the moving average and price, you can expect a normal correction. It's not going to be 5 or 6 cents. As general, on a normal day, a price reversal from a high in a bullish trend. In fact, I need to show you this so you can show this. On a normal day, let's say we've got a bull trend and prices begin to decline. The decline in general is going to hit within, it can be if it's really tight, anywhere between 5 and 10 cents. Hit the 34. In other words, any little bit of a correction is going to hit the 34. You can just count on it. If it's really sloping higher, then okay, it might be 10 or 12 cents. That sets you up for a potential 34B. It kind of bounces up and we expect a larger correction, and sure enough, here it comes. If you took the 34B, you would have had a loss. It's understandable. It was very overbought, even though I don't like that term, because prices very frequently get overbought. So you got to be careful about that. But nonetheless, prices didn't come in. With an additional 5 cents, you're going to now see that the prices hit the 89. And sure enough, that's what happens here. Right in here, we now have the potential 89B. What's happening right in here between the 34 and 89? Here it comes, the T20, T21. This is what we're talking about in regards to, from time to time, don't take the 89 bounce. Watch the T20, especially if the current price is well above a longer time period, such as a 15 or 30-minute chart. Of course, you could also look at the difference between the 200 and the 610 tick bar. That's the one that we're talking about. Is I now have a potential T20 here right in front of the 89. Otherwise, if you see prices do this, which happens from time to time, here's the highs, and now we're having a T20 underneath the 89. We like that trade. Because why? Because it's coming in normally within 20 cents from the high. And if we have a good size correction, then you're looking at the potential of 15, 20 cents of profit objectives. And if the market totally goes in the opposite direction, we're talking about a profit objective of 20, 30, 40. There are several times over this week, not this week, but over the last, let's say, 2 or 3 weeks, that what we have seen, uh, you could use a trailing stop of 10 to 15 cents. You have been able, from time to time, caught 50 cents worth of run. But generally, it's going to start from an overbought situation in the chart. I'm going to pull up the 610 so we can show. This is what I'm talking about. Look at the differential between the 610 and the 200. Do you see how wide that is? And you're seeing a 34B, and that's how far away? Only about 10, 12 cents. It then gets through that, and it hits the 89. About how far away? About 8 cents. That's what I'm talking about in regards to look at the differential between the 200 and the highs are the differential between the lows and the 200. And the reason being is in this particular case, from time to time, you're going to have a nice little run here. Let me show you again a good example of a runner. This is what I mean in regards to runners. Runners mean obviously you have a big move in a bearish trend. All time periods are bearish. The 15, the 30, the 60, the 610, the 34s, I mean the 233s, they're all going down, especially if you're breaking out the high or low of the previous day. This is when you're going to make a very nice return. And as this particular case, as I say, this is a 610, but you can use a pretty good size of trailing stop to catch some of those big moves. Any other questions? I hope this was helpful. Um, take some time. As you know, I'm a chart person who prints charts all the time. And I look back in history to learn a certain technique or particular strategy. Any other questions?